Good afternoon, everyone. We have a couple participants still logging in, but we'll go ahead and get started. It is 11 a.m. on a beautiful Tuesday afternoon. So welcome everyone to today's topic, top tax secrets for the real estate investor. My name is Tony Watson. I am here on behalf of Robert Hall & Associates. We are a full-service tax consulting firm based in now what seems to be sunny Southern California after the crazy rains. I think that it's going to be a little bit rainy today, and we'll be moving forward into the week with some more beautiful weather, but we all needed it, right? So hopefully everybody's staying safe out there during this this crazy weather period in sunny Southern California. Anyway, I love talking to like-minded real estate investors in these webinars for a number of reasons, because taxes and real estate, they go hand in hand in more than just a couple ways. So hopefully today we'll cover quite a few topics that you can take information with you and apply it to your own situation, or if you're just getting into real estate investing, you might be able to apply this throughout your investing career. But we'll get right into it. Robert Hall & Associates, we've been around since 1971. We service roughly around 10,000 tax filings per year, so we do see a lot here at Robert Hall. Our clientele roster, we're well over $1 billion in real estate operations, management, wholesaling, so on and so forth. So we do see a lot here at the firm. We are a family-run firm, been here in the Southern California area since, once again, 1971. We only have one location, but we do service tax filings in all 50 states. I myself have been working with the firm since, oh gosh, I think I'm going on 2 decades of service with Robert Hall & Associates. My individual column consists of roughly around $500 million in managed real estate and other business dealings. I am also the keynote speaker for Robert Hall and speaking at over 140 plus events per year. All of our education is free, just like the webinar that we're in today. So if you want to know or learn about more of our events in the upcoming months, you can check out our website, roberthalltaxes.com, and go to the events tab. I believe it's at the top of the webpage, and you can learn about our upcoming events. We'd love to see you in those events as well. I by no means am a one-man operation. I work alongside a wonderful senior consulting staff. We're about 55 employees strong here at Robert Hall & Associates. Obviously, we need those numbers to provide service to over 10,000 tax filings per year. So if you're looking for a new tax advisor, we are open for in-person and remote appointments. And tax season is in full swing. So if you are looking to onboard with a new tax advisor for this season, I will give you our contact information towards the end of today's webinar when we do Q&A. We're much more than just tax professionals. We offer incorporating services. We do internal auditing, financial planning, estate planning, bookkeeping, payroll, you name it, we service it. We're kind of like a one-stop shop for all of your financial needs. So keep that in mind. And we do once again offer free consultations. I will show this slide to you towards the end of today's webinar as well. But I do want to get into the bread and butter today. Let's start off with just a common reminder as to what are some of the top tax write-offs for real estate investors and real estate professionals. Coming out of the past 3 years under this very strange pandemic that we all had to live through, I did see some pretty unique changes in real estate investing expenses and deductions on returns starting in 2020. One deduction in particular that stood out on returns in 2020, 2021, and 2022, as far as change in amount is concerned, is marketing and advertising. I had more real estate professional clients plugging tens of thousands of dollars into marketing and advertising costs, unlike in previous years where it was kind of a more lower consistent write-off for those individuals. But we saw a lot of people really focusing on marketing and branding their names and their businesses during the pandemic years, most likely because people were working from home. There really wasn't a whole lot of door knocking and a lot of handshaking at in-person seminars or networking events during the pandemic. But as we come out of this pandemic, we're seeing more of the in-person seminars and networking events. But during those 3 years, we saw people revamping their websites, sending out mailers, doing everything they possibly could to stay relevant in their field of expertise. And so marketing and advertising, I saw in some cases double, triple, even quadruple for certain business owners. I did see also a correlation and consistency between increased revenue and increased marketing and advertising costs. The more people were marketing their businesses, the more they were advertising and branding themselves, the larger their revenue was year over year. And those individuals who spent a lot of time and money in marketing and advertising during the pandemic, they are still seeing a consistent growth in overall revenue, even in 2023. My last client last night actually had dropped close to 60 grand into marketing and advertising and lead generation services in 2022. And when a lot of real estate professionals are seeing a little bit of a slowdown in the market simply because of, or not simply because of, but possibly because of lack of inventory. It's not that they don't have buyers, they just have lack of inventory issues. I did see consistency in revenue growth for that client last night. So it speaks to the power behind marketing, advertising, merchandising, branding your business, your name, and reaching larger target markets. So that would be the number one deduction that I saw change during the pandemic, is marketing and advertising and data analysis and lead generation, so on and so forth, which is also a dollar for dollar write-off, by the way. Professional supplies and equipment, one of my favorite write-offs to talk about. Number one, because it has one of the lowest risks for audit. And number two, it is going to be probably one of the more consistent write-offs year over year. Even pre-pandemic, we were always seeing people buying new computers, buying cell phones, buying desks, chairs, filing cabinets, shelving units, storage units. This is one of the more consistent business write-offs in all fields of business, in all industries. The federal government expects you to have a computer, right? They expect you to have a cell phone. They expect you to have routing equipment and Wi-Fi hotspots and desks and chairs. So because they are some of the more consistent deductions that you will have as a business owner, they also in turn have the lowest risk for audit. Just as an example, in the past 2 decades that I've done taxes, I have yet to see an audit on a computer purchase. I have yet to see an audit on a cell phone purchase or a desk purchase or a chair. So once again, we have the ability to deduct these things dollar for dollar on our federal tax returns, and also enjoy the lower risk for audit on some of these items that we're purchasing. I also like this deduction for another reason. That was number one, low risk for audit, and obviously it's the most consistent write-off. But also number two, we have options of how to write these expenses off. When I go out and I purchase a laptop for my business, I can either take it fully in 1 year as a dollar for dollar tax deduction, or I can spread the write-off out over the lifespan of the asset, which a computer, a piece of equipment, for instance, has a 7-year lifespan. Furniture has 5-year lifespans. And so we can either take it in this year when we need it, or if we've already wiped out all of our profit with expenses, we can spread that deduction out over the lifespan of the asset and take it when we actually need the deduction. For instance, if you've already reinvested your profit back into infrastructure and you're already paying no income tax, why would you want to force this deduction on your return if you don't actually need it? Take it in a year when you actually need it. So spread it out over the lifespan of the asset. Number three, car and truck costs. The most common car, auto, and truck deductions are going to be mileage write-offs or actual car expenses, oil changes, tire replacements, engine repair. Mileage moving forward is going to be at about 65 cents per business mile, which is a pretty significant deduction overall on the business mileage side of things. But what we saw a lot of in the pandemic years in 2020, 2021, and 2022 is people going out and purchasing new cars. Not even purchasing new cars, purchasing used cars and taking advantage of the depreciation write-off upon asset acquisition. Meaning that if I'm a business owner and let's say that I'm looking out the front window and I see this 1998 vehicle that is on its last leg, and I've spent more money repairing that vehicle over the past couple of years than what it would cost as a down payment on a new vehicle, and I'm thinking I really need to get that new vehicle. As a business owner, I might want to acquire a new vehicle under my business name, whether I'm incorporated or working as a sole proprietorship, to take advantage of something called bonus depreciation on that asset. Vehicles in 2020, 2021, and 2022, obviously we all saw cost of vehicles shoot through the roof, and we all thought, well, this could possibly be because of supply chain issues, the chip shortage issue during the pandemic. But another driving factor in auto sales was the benefit on the tax side of things. If I went out and I purchased a 6,000 pound or heavier vehicle under my business in 2022. So that would be the Chevrolet Tahoes, the GMC Sierras, the Tesla Model X's, the Mercedes G-Wagons, these large heavyweight vehicles. And I purchased it for business use under my business. Because of the weight class of the vehicle, weighing over 6,000 pounds, the federal government was allowing me a 100% tax write-off for that asset, meaning that it was 100% tax deductible for me on my federal tax return. The state didn't conform to that benefit, unfortunately, but the federal government was allowing that to be deducted at 100%. Now, you have to title the vehicle, you have to insure the vehicle, you have to pay for the vehicle in very specific and unique ways, but have this conversation with your tax advisor to make sure that if you did acquire a vehicle last year, that you're getting some sort of benefit for that bonus depreciation. That benefit is still around for 2023, but not at 100% or not at a 100% write-off. Starting January 1st of 2023, that 100% bonus depreciation has dropped to 80%. So it's not that we're losing 20% of the write-off, it's just we get 80% upfront and we take the remaining 20% of that asset value and we depreciate it over the remaining 5 years of the asset life. So vehicles have a 5-year asset depreciation lifespan and we get 80% upfront. So let me kind of explain that in more detail. Let's say you've got a business that you're operating that has $100,000 in profit. And let's say you go out and you buy a $100,000 Tesla Model X, you title it, you insure it, you pay for it correctly to allow for that bonus depreciation deduction. Well, at 80% of $100,000, you get an $80,000 write-off, dollar for dollar in the first year for in 2023, and then $20,000 is a write-off over the remaining 5 years, which gives you what, a $4,000, $3,800 write-off per year over the next 5 years. And that reduces my $100,000 profit by $80,000. So instead of paying tax to the federal government on 100 grand, I'm only paying tax to the feds on $20,000 because I'm allowed that dollar for dollar 80% bonus depreciation write-off. I think that this was also a driving force in the automotive industry from a tax perspective because it allowed people to save a lot of money. And they were already looking to purchase a new vehicle, but instead of just going out and buying something just on a whim, they were contacting their tax advisor saying, hey, should I be acquiring this in a specific way? Should I be paying for it in a specific way? And then they jump through all the hoops, they go through the process of acquiring the vehicle, and then they realize that insurance is going to be a little bit more expensive because now it's a corporate asset and they have to pay a fleet vehicle insurance policy versus a regular car insurance policy. But at the end of the day, I'll say, who cares, right? Because of this massive tax write-off, now because the vehicle is an asset of the business, the insurance is now going to be a dollar for dollar write-off as well. So once again, you gotta go through the motions, you have to jump through the hoops in order to get this major benefit. But if you're taking the depreciation write-off, you're not going to be taking the mileage deduction, at least in this year. Now, once the depreciation is fully exhausted, then you can go back to the mileage write-off or the actual auto cost expense. But these are great overall ways to shelter income and be able to deduct something that you probably didn't think or consider to be a business write-off in the first place. But once again, there's very unique and very important ways to acquire that vehicle, to title it, to insure it. So make sure you have this conversation with your tax advisor first before purchasing that vehicle. Number 4, legal and professional fees, dollar for dollar tax deductible for self-employed individuals and real estate investors, but not for W-2 employees. Like myself, here at Robert Hall & Associates, a majority of my income is W-2 income. I have real estate investments. I have other side businesses that I get to dollar for dollar deduct these types of costs. But if you are solely a W-2 employee, legal and professional fees since 2018, no longer a write-off. But if you are a real estate investor and a small business owner, a self-employed individual, this deduction is still a great dollar for dollar write-off for you. We saw a lot of legal and professional deductions during the pandemic for a number of reasons. I'm not going to go through that whole list of reasons today, but this is still very much a great dollar for dollar deduction for business owners and real estate investors. And that also includes tax preparation fees as part of the legal and professional write-off. Last but not least, something that it's probably common knowledge now, most people were working from home during the pandemic. They were no longer working from brick and mortar type commercial buildings. They were forced to work from home. Some people have returned to the office. Some people have not. And so the in-home office deduction has become a consistent write-off once again for self-employed individuals and real estate investors / real estate professionals. For those of you who have heard that in-home office deductions tend to have a higher risk for audit, it is true, but it's not the form that gets people audited. It's the misallocation or misrepresentation of office space inside of your house. So once again, it's not the form that gets people audited. It's actually the unreasonable allocation of square footage that you're using inside of your house. For instance, I get this question a lot, by the way, both in seminars and in one-on-one consultations. What is the most consistent percentage of my home or people's homes that is used for in-home office deductions? Well, it would be unfair for me to sit here and tell every single person in today's webinar, and it's a pretty sizable group today, for everybody to take 25% of their house as a write-off. That's unreasonable. That's unfair, because it's just not true, right? Some of us might live in 1,000 square foot homes. Some of us might live in 4,000 square foot homes. Everybody's home square footage is different. So if I tell you 25% is the average ratio to use, 25% of 4,000 square feet is 1,000 square feet. That's a massive in-home office. Now, if it's true that you do truly have 1,000 square foot office space inside of your house, maybe you converted a garage into a full-blown office space, or built an ADU or a granny flat in the backyard, and that is solely used for office space, and that's 1,000 square feet. Do not be afraid to take that as a write-off. That is a true allocation of square footage for office space. But most of us don't have that type of allocation. So I can't tell you 25% is industry average. I'd say that you truly have to be pretty accurate with your estimate. And at that point, do not be afraid to take the in-home office deduction as a write-off. This is an ordinary, necessary, and legitimate write-off for business owners. And I just want to, put another note out there. If you work with a tax advisor that tells you, hey, we shouldn't take this as a write-off because they fear being audited on this deduction, you need to work with a different tax advisor. Once again, this is it checks off all the boxes. It is ordinary, necessary, and legitimate from a deduction standpoint, and you should not fear taking this as a deduction on your individual business or self-employed corporate returns. Now, as far as allocation of square footage is concerned, you can use the actual office space, and then you can also include the nearest restroom to that office space. So you have to combine that square footage to allocate for office space. But that is, once again, a great dollar for dollar write-off. Property deductions outside of in-home office would include mortgage interest, property taxes. On the in-home office side, you allocate a percent of your utility costs, a percentage of maybe office repairs or maintenance or improvements to your office space. So make sure that you're having this discussion consistently with your tax advisor year over year, and not losing out on this great overall tax savings write-off. Now, let's talk about the most audited deduction, which once again is going to be the in-home office form. But once again, you should not fear taking this deduction. This is actually, it looks like a picture. This is not my wife, but I can only imagine that she runs multiple businesses from home. We have 2 young children, so I'm sure that during the pandemic, this was very much a reality for her. It was a reality for most people, I think, when the kids weren't going to school or weren't going to daycare, and they were all at home while mom and dad worked. So but this office space is a reasonable deduction. And once again, just as a reminder, it's not the form that gets people audited. It's the unreasonable allocation of square footage that throws up red flags left and right on this deduction. So just make sure that you're mapping out a strategy with your tax advisor before just plugging in numbers to see what saves you more tax. This is very much an ordinary, necessary, legitimate, and above and beyond reasonable deduction for you to take as a self-employed individual. Now let's talk about in-state versus out-of-state investing really quickly, because I had a lot of clients leaving California with their investments during the pandemic. Over the 2-decade career that I've had as a tax advisor, I have clients all over the US. I think probably just myself in probably 47 states. Our firm files taxes literally in all 50 states. So we do see a lot of people diversifying their portfolio, not even within the California borders anymore, but within the borders of all 50 states. I've seen a lot of clients investing in Montana, in Nevada, in Texas, in Florida, Wisconsin, Wyoming, Idaho. Boise has been kind of like a hot market right now for some of my clients. And a lot of people doing long-term investing, as well as the VRBO, Airbnb type short-term investing, in investments. So we've seen really, really consistent movement within the real estate industry, both in and outside of the state of California. But what are our rights as California investors when we do own investments outside of the state of California? Well, California is a very unique state when it comes to tax code. And so California states that if you individually reside here in the state of California, you can own investments elsewhere in the US, but you still have to pay California state income tax on the revenue that you earn outside of California. Now, before you start throwing things at the camera and smashing your computer screen and saying, hey, how can California do that? Understand that in other states where you owe tax, you actually get a tax credit on California's return for the state tax that you pay elsewhere. And then you get a California credit on that state tax return as well. So we have kind of like a double taxation treaty with most states. The only states that this really doesn't work well in are states like Nevada, Texas, and Florida, where there is no state income tax. So if you're not paying tax in Nevada or Texas or Florida, then you pay the full-fledged rate of income tax to the state of California. California is one of about 8 or 9 states that taxes its residents on their worldwide income. Lucky us, right? Obviously, we pay for the rain, the snow, the great sunny weather from time to time nowadays, but we pay for air, it seems like, here in the state of California. But once again, the real estate market and the opportunity here in California, I think it's second to none. We can argue about that at some other time. Politics might be another discussion. We're not going to talk about that today, but there is more opportunity to make money here in the state of California than most other states. I think New York is probably a close second. And yes, people can make money elsewhere, but there's nothing like Golden Coast real estate, right? Whether the economy is good or bad, people are always looking to find a deal here in the state of California. The cash flow is unlike any other. The value of real estate is unlike any other. So California knows that. And California wants to make sure that you pay your fair share of tax in their mind, your fair share to the state of California if you reside here. Now, what defines residency? Let's talk about that really quickly. Definition of residency to the state of California is, where are you registered to vote? What address do you have on your driver's license? If it's a California address, then California is your state of residency. And then what state license plates do you have on your vehicle? If you drive around a car with California plates, if you have a California address on your driver's license, if you register to vote here in California, by definition, you are a resident of the state of California. So make no mistake, that's how California defines residency. Now, if you are a high earner, a high taxable income earner in the state of California, they do also have the ability to audit your cell phone records and your utility bills. Now, I haven't seen this more than maybe once or twice in my career, and it wasn't even with clients of mine. It was a case study that we had probably 7 or 8 years ago, where California had audited this client. He did a 1031 exchange out of California with about $10 million of real estate, and took that portfolio and bought 150 units elsewhere in the US, and California audited the exchange. They found that there was boot that came out of that exchange, and he claimed that he wasn't a California resident at the time of the exchange and that he had already filed the California exchange paperwork. And so they ended up auditing cell phone records and utility bills. And they actually determined in this case study that he spent 51% or more of his time in California at a property that he owned here, even though he was registered to vote elsewhere, drove around a car, I think, with Nevada plates in this case study. And he jumped through all the hoops to do that. But because of the audit of his cell phone records and his utility bills, they determined that California was his actual state of residency. That was one scenario out of 2 that I've seen in my career. I'm sure there are other case studies built around this, but I do feel like they wanted to make that client a poster child for auditing in the state of California. I don't foresee that as being an issue for very many taxpayers. So once again, have this conversation with your tax advisor about what hoops you need to jump through in order to truly avoid, not evade. Remember, tax evasion is illegal, tax avoidance is not, but how to properly avoid paying state of California income tax by registering and setting yourself up correctly out of the state of California. We've seen a lot of people exit California over the past 3 years. I call it the mass exodus. I have some clients now coming back into California, but a lot more leaving than coming back in. So we did see a lot of this in the past 3 years. I do foresee over the next decade that California, when they start to try and collect a lot of the revenue that they've been paying out over the past 3 to 4 years, that there will be some changes to their auditing procedures for out-of-state residents. who have California generated revenue, but probably a discussion for another day. Just keep this in mind that there are other opportunities outside of California with great cash flow benefit. You don't only have to focus on California real estate. And if you're looking to exit out of California, do not sell your properties in California outright. Exercise a tax-deferred 1031 exchange to take that capital gain and avoid paying tax on the California gain and exchange it for other assets outside of the state of California and avoid tax. That's the goal with a tax-deferred exchange. Now let's talk about some major differences between the three doors, the three things that you see here on the screen, the LLC, the trust, and the insurance policy. When you open up each one of these doors, it leads you into a completely separate room. They are not connected, meaning that you are receiving a completely different and unique benefit for each one of these items that you see here on the screen. The number one most important thing for us to have is insurance. Make no mistake. Insurance is there and in place to pay out settlements in case an unforeseen event happens, right? I hope that makes sense. Insurance is there and in place to pay out a settlement in case an unforeseen event happens. We don't know that, we're pulling out of a driveway and somebody's speeding through a red light and they sideswipe our car. So we have car insurance, we have health insurance, we have liability insurance in place to pay out whatever settlement there is in that particular scenario. We have rental property insurance in case our tenant burns down our house, right? We have earthquake insurance in case that big one hits, which it will eventually someday. We don't know when, but when it does hit, we have earthquake insurance and it's there and in place to pay out whatever settlement that is or to rebuild the home in case that unforeseen event happens. So insurance is by far the most important thing for us to have. Insurance, however, does not separate personal and business liabilities, risks and liabilities. That is where an LLC or an S Corp or a C Corporation comes into play. That's where an entity structure comes into play. So an LLC is great for liability protection. It doesn't pay out settlements like an insurance policy does, but what an LLC does is it allows us to separate our business assets like rental properties from all of the risks and liability that we carry personally on a day-to-day basis. So asset separation equals asset protection and vice versa. Now, I'm not sitting here telling you all to leave this webinar and to set up all of your individual rental properties in their own individual LLCs. That's not what I'm saying. I'm saying, that you should have this conversation with not only a legal advisor to make sure you're setting up the legal entities correctly, but also talk with your tax advisor about the financial obligations you tie yourself into with the state of California by setting up individual structures like LLCs, S Corps, and C Corporations. There is very much a right and a wrong time to incorporate your rental property and your small businesses. So you need to talk with both of your advisors, the legal advisor and the tax advisor, just to make sure it's the right option for you at this unique and very specific time in your career or in your investment career. The trust is not like an LLC. It's not like an insurance policy. The trust actually protects you when and after one major life event happens. And that life event is death, right? I mean, the trust is meant to protect you in death, meant to shelter your assets, protect those assets from probate here in the state of California or any other state that you own assets in. And it's meant to provide a smooth transition of legacy inheritance with your assets to your next of kin. If you're donating your assets in death, you might have a charitable remainder trust, which inherits the assets and then donates the assets to 501c3s. But a trust does not protect you from potential litigation, current time litigation like an LLC does, and a trust does not pay out settlements in case an unforeseen event happens. So as you build your wealth in business, as you build your wealth in real estate, you will eventually have all three of these things in place. You probably already most likely, more likely than not, have insurance in place. Hopefully you do, like health insurance to fix our bodies in case we get sick. And the insurance policy is attached to the asset, and the asset is owned by the LLC. And the owner of the LLC is not you individually. The owner of the LLC at that point is your living trust. And that is the most common structure to have in place. So it protects you in case something, an unforeseen event happens. The LLC is there to protect you from potential litigation. And then the trust is there to protect you in death from probate. So I think that this is all a very unique structure to have set up. probably not going to apply to everyone all at once right now, but as you build your wealth, you'll absolutely want to start this conversation with your legal advisors, with your tax advisors, with your trust attorneys, all of the right professionals in place to advise and help you set up this structure. Last but not least, I wanted to mention these are 4 new slides that I've added to my most recent presentations. I wanted to talk about cost segregation. For the 80 plus attendees in today's webinar, some of you might understand cost segregation. Some of you might have heard this term before, but don't really know how it works. Some of you might be like, well, what's cost seg? Is cost seg another variant of COVID? No. Cost segregation is a very unique and special election for real estate investors. And the best way I can describe cost segregation through this special election that your tax advisors will help you make on your return, it gives you the ability to reach forward into future years, right? So years where you haven't even taken deductions yet, reaching forward into future years and accelerating those future year deductions to take them all in this calendar year. Now, the numbers have to make sense to do this, right? You have to have significant cash flow through your real estate investment properties in order for you to take advantage of this. Well, not significant cash flow, but you have to be making some sort of income through your rental properties in order for this to make sense. So for the individuals who have low debt on their property, who keep acquiring these short-term investments and they're cash flowing like crazy, and they're just figuring out other creative ways to reduce taxable income because they've already made all of the necessary improvements and their property is just in a great area and people are paying an arm and a leg to rent out this specific unit or property wherever you're investing. And so you're always asking your accountant, is there anything else that I can do to help shelter tax against this income? Well, cost segregation over the past 3-4 years has become incredibly popular. I mean, I've known about cost seg for a really long time, but prior to the pandemic, I feel like I would file maybe 1, 2, 3 cost seg analyses, maybe every couple of years. During the pandemic, during the 3-year period, 2020, 2021, and 2022, I filed more cost seg elections in that period of time than collectively over my 20-year career with Robert Hall. That's how important it's become to real estate investors. So how the heck does cost segregation work? Well, I've managed to put together a very unique example for you. This is actually a real life example with a taxpayer I helped, and it's kind of middle income household with some nice cash flowing assets. This individual owns 3 rental properties. And the cash flow in this scenario for 2021, this is a 2021 election that we made. The cash flow on the real estate portfolio side, as you can see, about 5 or 6 lines down from the top, cash flow is about $33,183. And this client comes to us in 2021 saying, hey, I'm going to have this cash flow. I've been able to pay down the debt pretty significantly. I actually acquired one of the assets fully in cash. So I'm kicking out some nice cash flow on a month-to-month basis. This particular taxpayer is a city worker, not a real estate professional. So there are some limits as to what he can deduct for real estate losses. The W-2, I think it's a city worker with the city of Los Angeles. And so they've got this nice, strong W-2 income, and they've got this nice cash flow through real estate. So when we did the analysis for 2021, and we dialed in these numbers based on the cash flow and the W-2, this taxpayer was looking at owing the IRS at the very bottom there, circled in red, owing the IRS $4,018 in federal income tax, and to the state of California, about $4,287. So about $8,000 and change overall in federal and state income tax. This is including, once again, $33,000 of cash flow on 3 rental properties. So we dial in the cost seg election analysis. We calculate how much we can reach forward into future years and accelerate in deduction to take all in this year. And if there's any excess deductions that he isn't able to use because he's not a real estate professional, we'll be able to carry those forward into future years and continue to offset cash flow in 2022, 2023, 2024, as far into the future as possible. But we need that major deduction in 2021. So through this cost seg analysis on this 3 property portfolio, we were able to accelerate $173,000 in future year depreciation. Basically, through cost seg this election, we look at his 3 properties and we figure out any improvements to those properties that have a depreciation lifespan under 20 years. I know that people's eyes are rolling back in the back of their head. They're thinking, Tony, this doesn't make sense. Can you explain it in more detail? Absolutely. So a residential rental property, just right out the gate, has a 27.5-year lifespan. That means that the value of the building you get to take as a write-off, but over 27 and a half years. Let me map this out for you. Let's say you buy a $500,000 rental property, and let's say 65% of that is building, 35% is land. So 65% of 500 grand is $325,000. That's the value of the building in a $500,000 acquisition. If you did not do cost seg, you'd have to wait 27 and a half years to get this full $325,000 building as a write-off. That gives you per year over 27 and a half years, $11,818 in depreciation deductions, which is a phantom expense. It's not you actually coming out of pocket to pay for this write-off, but that is a phantom deduction that you get to add onto your return on top of mortgage interest, on top of property taxes, on top of, insurance and improvements and repairs and travel and so on and so forth, right? So you'd have to wait 27 and a half years to get $11,818 per year. Through cost seg, we're able to look at those three properties in this scenario and separate out anything that has a depreciable lifespan under 20 years. So we're talking about plumbing or piping, light fixtures, electrical outlets, cabinet improvements, anything that essentially isn't a 27.5-year lifespan depreciable item. So in this scenario, we were able to separate out $173,000 for this taxpayer A and take it all in 1 year. Now, that does leave him less depreciation in future years, which he was fine with because he doesn't ever plan on selling these properties. He just wants to figure out how to save as much money as possible this year in 2021. And with that tax savings, he wants to buy more real estate, right? So when we accelerated this $173,000 write-off, he wasn't able to take it fully. He was only allowed $40,000 of this write-off in the first year, and then $130,000 of the loss then carries forward into 2022. It will offset all of his cash flow in 2022. Let's say it's another 40 grand. Then he's got $90,000 carrying forward into 2023, and so on and so forth until it's fully exhausted. That means that over the next 4 to 5 years, he's not going to pay any tax on his rental property cash flow. It's like the holy grail of tax shelters without really even doing anything except for this cost seg analysis. That changed this taxpayer's bottom line. Instead of owing $8,000 and change to federal and state, as you can see, his 33 grand in cash flow dropped to a negative $11,549. So he wiped out about $44,000 of income. And now he dropped himself out of having a liability to the federal government. I think it was $4,000 and change, into having just shy of a $6,000 refund. So that's a $10,000 sway in federal tax. And on the state of California, he ends up having a $1,392 state refund, which at the end of the day was about $5,300 in tax savings. So he saved $15,000 in tax by taking a $40,000 allocation of write-off. And the only reason why he's not allowed the full 173 as a write-off is because he's not a real estate professional. He's a city worker. If you're a real estate professional, if he was an actual real estate professional, a licensed realtor, or somebody who makes 51% or more of their income through real estate related activities, he would have been allowed the full $173,000 write-off all in 1 year. It would have kicked him into having a net operating loss where his overall income is negative, and he would have paid no tax anyway, right, on that scenario. This taxpayer still ends up leaving some money on the table with the government, but he's fine with that because he's not losing the remaining part of the loss. He's just carrying forward the remaining loss into future years. So for the next 4 to 5 years, let's say that everything is pretty stable with W-2 income, cash flow on his properties. Over the next 4 years, he's going to save 15 grand on average per year. I think that 2022, he ended up saving closer to like 23 or 24 grand because he had more cash flow in 2022 than he did in 2021. And guess what? With all of this tax savings now in 2023, he's got enough saved up with some other savings to now buy another property. Guess what we're going to do in 2023 with this new property acquisition? We're going to do another cost seg analysis. And so he's going to add to that major loss carry forward. And hopefully, if we just copy and paste cost seg year in and year out, he's not going to pay income tax on his cash flow for a decade. And now all of a sudden, after a decade, when he decides to retire and just live off the cash flow from real estate, he won't be doing cost seg anymore because he won't be acquiring any more real estate. He probably will acquire real estate until he's 6 feet under, to be real honest with you. But if he decides to walk away from acquisition, he can retire on the cash flow because he's been able to avoid paying tax over a 10-year period on his cash flow. And with all of that tax savings, he's just buying more real estate. once again, the holy grail of tax shelters, cost segregation. One thing did change as of January 1st of 2023. Unlike in 2022, cost seg analysis was allowed at 100%. So we were allowed $173,000 of that bonus depreciation for this client in 2021. 2022, we would be allowed 100% of it as well. Unless he's a real estate professional, there might be some limitations on that. But starting January 1st of 2023, that 100% bonus depreciation drops to 80%. So once again, kind of like the car discussion with the bonus depreciation, you're not losing 20%. You just get bonus depreciation on 80%, and the 20% is then carried over the lifespan of the asset. So still a massive overall adjustment to income, still one of the holy grails of tax shelters. So make sure that you are having this conversation with your tax advisor and seeing if it works for you, especially if you have cash flowing assets. If you're a real estate professional and you are practicing what you're preaching, whereas you're selling real estate and earning commission income, but also buying long-term or short-term investment property, this is once again the holy grail tax shelter for you. It can not only help offset your real estate commission income because you're a real estate professional, but it could also offset all of the cash flow on your real estate rental portfolio and all of those dividends, those cash flow investments. So just keep that in mind. Once again, very, very popular these days, cost seg. We have some great cost seg specialists that we have as vendors and referrals here at Robert Hall. So if this all of a sudden makes sense and it's turning on some light bulbs, make sure that you reach out to Robert Hall and Associates after today's webinar, and we can do some consulting work with you on all of that. I mentioned real estate professional a couple times, and before I kind of wrap up here, I want to mention that real estate professionals are not just licensed realtors. The license definitely helps. That's kind of the icing on top or the cherry on top, whatever reference you'd like to use there. But it doesn't necessarily mean that you need to be licensed to be a professional. I know a lot of people in the real estate world who own 10, 15, 20 plus investment properties. That's what they do full time. They manage their properties, they wholesale, they flip, they manage. I mean, if that's your main source of income, you do not have to be a licensed realtor in order to be a real estate professional. You just have to meet very specific and unique requirements in order to claim the real estate professional status on your return. There is an hour requirement. You have to spend over 750 hours working within the real estate related industries. The 51 rule applies. Where does 51% or more of your income come from? Is it real estate related activities, or is it accounting practice activities? And where does 51% or more of your, 51% or more of your income, and where is 51% or more of your time spent? So that's the 51 rule. On the real estate rental property side, you have to actively participate over 500 hours per year, which seems like a lot of hours. It really isn't. To generate 500 hours. Shoot, this hour of webinar is included as part of real estate professional education. So, you add up all of those hours under audit. Once again, this is really only important if the IRS decides to question your real estate professional status, and your accountants will help you put together that information in case you ever need to put together an hour log. But once again, before you check that real estate professional box on your return, make sure you understand why you're checking it and why you qualify. The real estate professional election, much like the in-home office deduction, it's one of the highest audited elections on your individual return. So before you just start checking boxes to see a greater benefit on the bottom line liability or a greater refund, make sure you understand why you are checking that box. It is not the Wild West. It's not saying, oh, well, because I answer a couple emails from time to time with my realtor and I know as much as he or she does, yeah, that doesn't make you a real estate professional. There definitely have to be some qualifications and requirements that need to be met in order for you to make that election. So just keep that in mind. And your tax advisors can help you determine whether or not that real estate professional election works. So I'm going to open it up for Q&A here. I'm going to leave it on this screen. This is the best way to engage with Robert Hall and Associates for the free consultation. You can either text Robert Hall to the number 72,000 or open up your smartphone camera and scan the QR code at the bottom right part of the screen during this free consultation. And even if you're not looking to onboard with a new preparer, at least use this as a second, as a free second set of eyes on your tax return, a free analysis of what's already been filed for you. And if you like what you hear, then you can onboard with us. But if you're not looking for a new tax advisor, this is also the best way to add your name to our free educational webinar list. So whenever we have free educational webinars, we will e-blast whoever is on that list and let them know, hey, this Wednesday night at 8 p.m., we've got a webinar for the Power of Inc. Tonight, Aram Gabudian, one of my close friends and also the realtor who has helped me acquire real estate in past years, we have a webinar tonight, and he's going to talk about real estate and kind of where the market's at. He's with KW, Keller Williams. And then I'm going to talk a little bit about the Power of Inc. and what we're seeing on the tax side of things. My portion of tonight is very short, but we do 140 events every single year, some in person, some webinars. But yeah, this is the best way to be added to that list. So if anything, just, send us your information so we can let you know about the free educational webinars and changes to the Internal Revenue Code, just keeping you apprised of anything that we might think is important for the U.S. taxpayer to know about. Let me go to the chat box first. I see that people are using the chat box and the Q&A section. Louis, I hope you were able to figure out the sound. That was the only person who had messaged about sound, but everything seems to be working on my end. So hopefully you got that fixed. Rashawn, I'm a realtor, not a real estate investor. Would your seminar benefit me? Oh, absolutely. I mean, this is for the real estate investor, which is also the real estate professional. My realtor clients, the deductions that we talked about would be dollar for dollar for their businesses as well. Cost segregation, that was really rental property investor related. As far as everything else, the bonus depreciation on the vehicles, the LLC versus trust and insurance policy, that applies to realtors as well. Rashawn, if you're still in the webinar, I think that the Power of Inc. would be something that you'd really benefit from if you already aren't incorporated. So let's keep that in mind. Will you be sending out the recording? So the recording will be available, I believe. I'd have to check with our marketing department to see where that'll be posted. Information does change in the tax world. And because we do so many webinars, I feel like I'm going to do this exact webinar probably in the next week or two again. But we are recording this. We record every webinar that I give. So I'll have to check with marketing to see when that'll be posted. Was that 50 cents per mile? No, 65 cents per mile for mileage. I think that's your question, AJ. That'll be 65 cents per mile for this year. I think it's 65.5 cents actually. I'll have to double check, but it's around 65 cents per business mile for 2023. Deanna, even if you have taken a loan out on vehicle, yeah, so the vehicle depreciation still works even if you aren't acquiring it fully with cash. Even though you are acquiring it with a loan, you are still buying the car. You're just using somebody else's money to acquire it, right? So whether you finance the car or not, it's still going to qualify for that bonus depreciation write-off, which is fantastic. Jane, is the 100,000 purchase has to be paid off one time, or can it be a loan? Yeah, so once again, it can be a loan. It does not have to be paid outright in cash. And same for buying an investment property. So an investment property, the depreciation on a property comes whether or not you buy it outright cash or whether you have a loan on it. It's just the loan allows you for the mortgage interest deduction. That's really the only difference if you have a loan attached to the property, but depreciation works the same on rental investments. Now, in order to take bonus depreciation on a rental investment property, you have to do cost segregation, right? You can't just check that you want to fully accelerate the value of the building without going through a formal cost segregation analysis. So just keep that in mind. Rashawn, can one deduct mileage and car expenses? No, you can't do both at the same time. You can only do mileage or actual car expenses. You cannot deduct both at the same time. Daisy, is this being recorded? So yes, it is being recorded. I'll have to double check to see if there's to see where it'll be posted or available. Claire, you're a realtor in Texas. Yeah, great. I mean, I own some properties in Austin, some family investments in Austin. But I'm envious with the no state tax. So hopefully the weather out there and everything is going well in Texas. Stephen, I live in Northern California, realtor, but I get a sense I may need your services because I have out-of-state rentals. Can your agency work with me? And do I need to find a tax advisor, or do I need to find a tax advisor? No, we work with everybody in all 50 states. In fact, because of the pandemic, finding a little bit of silver lining in the pandemic, we actually are more set up for digital advising than we have been over the past 50 plus years of being in business. I worked from home for almost 2 years during the pandemic because the LA Health Inspector's Office came and shut us down. We were seeing about 110 to 120 people, warm bodies in our office every single day, Monday through Saturday, prior to the pandemic during tax season. We do volume here. We have, once again, over 10,000 tax returns that we prepare each year. And most of them were in person prior to the pandemic. And then all of a sudden, when the pandemic shut the economy down, the health inspector's office came to our office and said, hey, we had an internal building complaint with one of the other suites. We need to shut you down. You have too many people coming in. So for 2 years, I worked from home. We've got a great portal system. We have a smart vault set up where you can upload your information. We set up FaceTime or Zoom calls with our clients, or we could just do it by phone. We suggest that you get your information to us, or we require, but not suggest, we require that you get your information to us at least a week prior to the appointment. We prepare as much of it as possible so we can really maximize the appointment scheduling time to answer questions and to get everything prepared. But yeah, to answer your question, we could do tax returns in all 50 states. Even if you're in Northern California, that's probably a little bit easier. If you want to take a trip down to LA from Northern California, you can come and see us in person, but we are readily available to assist. I'm going to switch over to the Q&A box really quick because I don't want to neglect those questions. Deanna, for car, is this a sole trader as well, even with loan? Yeah, sole proprietors are allowed to deduct the vehicle. However, if you only own one vehicle, you have to allocate it by percent usage, right? So how often do you use it for business versus personal use? So once again, if you're a sole proprietor, you are not acquiring it as a corporate asset. You're acquiring it as a sole proprietorship. So you have to allocate business versus personal use. That's the only major change on the sole proprietor side of things. Jennifer, what contact info do I use to contact a tax pro at your firm? So this, once again, this is the best way to engage in our services. There's a whole formal way to engage in a tax advisor's services. You have to go through the onboarding process if you're not a current client. This is the best way to engage in our services. And, we're still open for appointments during tax season. Mine right now is kind of a cancellation list. So because I've been booked through April 18th since like mid-October of last year, it's been kind of a crazy year. A lot of accounting firms have closed down in the Southern California area. So we have a huge influx of new clientele. But we do still have openings before the April 18th deadline. So make sure that you contact us as soon as possible to get on the calendar. Anonymous, great job. Thank you. Thank you for the compliment there. What's the most efficient way to handle all the invoice and receipts? I'm a big QuickBooks person. QuickBooks is probably the most user-friendly out of all the bookkeeping software platforms. If you don't want to use QuickBooks, you could use Excel documents. I know that there are some software programs that will allow you to take pictures of the receipts. Under audit nowadays, the federal government will actually allow you to use your credit card statements as proof or evidence of the expense. Amex, for instance, American Express, gives you at the end of the year a little pie chart that tells you how much you spent in supplies, how much you spent in gas, how much you spent in utilities. It'll actually break it down for you. Stride, Claire says Stride is a free app that she uses. I'm a big advocate of Mint. Mint.com. Mint.com was actually acquired by Intuit. It now is an algorithm or a software used under QuickBooks. So once again, there's a ton of software and applications that you can use out there. I'm a QuickBooks user, so that's the one that I really promote, but whatever works for you, I guess. What are your fees? So fees range because everybody's tax return is unique. Everyone's tax return is different. We charge by form filed with your return. So, if you've got an S corporation, base fee for S corps is $11.99. Then you have the depreciation schedules and whatnot. But, once again, the larger the corporation, the fees could be extended a little bit further. But on average, you're looking at about $11.99 for an S corp or a C corp or a partnership return. For individual tax returns, they start at $7.99. And based on the amount of forms you file, it could become a little bit more complex than that. But very kind of industry standard, kind of middle of the road costs, at least here in Southern California, for corporate and individual tax preparation fees. But once again, don't let the fees deter you from our services because I feel like that's a little short-sighted. I mean, if we can onboard you and save you tens of thousands of dollars in tax by implementing our unique strategies and planning sessions with you, I mean, what's an added fee? You know, if you're paying $600 now and it's going to be $600 more to file your corporation with us, but coming with us and onboarding with us, our strategies will help you and our advice will help you save tens of thousands of dollars in tax. It's an opportunity cost. It's a cost of doing business at that point. So please do not let, I know I don't ever want to deter from that question. I don't like talking about our fees because I feel like people all of a sudden, you know, just kind of put blindfolds over their eyes. I mean, if I could save you more than your current accounting firm, or if we can save you more than your accounting firm right now is saving you, that's just a cost of doing business. And it's helping you retain wealth at the end of the day. So keep that in mind. Okay. Power of Ink, a book? No, Power of Ink is actually a webinar that I created years ago, and I still do. It's probably one of my most popular webinars, and it's the power of incorporating. So it's the power of INC, not INK. So the power of incorporating is another webinar that we do. So once again, take this, text Robert Hall to the number 72,000. We'll let you know when that Power of Ink webinar is going to be available again, or when we're going to speak on that. I have about 4 more minutes to answer, and then I got to hop off for my noon appointment here. Anonymous, what is the best way to calculate mileage for real estate? Mile IQ. Mile IQ is a smart device application. You can download it on your cell phone. You can download it on your tablet. You know, basically when you hop in your car, you start the Mile IQ app. It will allow you to separate business mileage from commuting mileage from personal mileage. It is probably the most popular app in the industry. Obviously, if anybody else has any other suggestions, you could put that in here. Mile IQ happens to be the most popular. That's the one that most of my clients use. Ravi, if we pay off the car loan in the year, do we still get the benefit of course, yeah, if still get the benefit of the car depreciation. Yeah, it doesn't matter if you pay off the car or if you have it, or if you have a loan against it. The depreciation is based on the value of the car and the weight class of the vehicle. So once again, whether it has a loan, whether you pay it off, whether you keep the loan on the car, it doesn't matter. The depreciation still applies. I need you guys to do my taxes, California realtor with 2 rentals. Okay, so Gems, I'm going to, gosh, I'll keep your information. I'm going to go ahead and send it over to our appointment scheduling desk. We'll get you a call. We'll get a call out today to get you set up with the appointment. I'm going to actually, you know what? I'm going to go ahead and take that now because I don't want to exit out of Zoom and then it get deleted for some reason. So I'm going to send that over to our marketing department now. So we'll be in contact soon. Gems, again, may I have a recording of the Zoom, please? Absolutely. We can make that available. Once again, I just got to check with our marketing department of how that's going to be made available. I believe that we can send out to all the attendees today. I think we can send out a link, I believe. Don't quote me on that, but I believe that is a possibility, but I'll have to get back to you, all of you on that. We answered the consultation fee side of things. Is hiring overseas staffing a write-off in Cali? So when you hire, this is kind of a 2-part question, I think, because if you're hiring contractors overseas, there's a very specific form and a very unique way of writing that off. If you have employees overseas, you still run payroll for those individuals. And in theory, if they work for a California-based business, and they're not a California resident, they still have to file a non-resident tax return here in the US if their taxable wages are over 12 grand. So if they don't, then you're required to automatically withhold tax from their pay before you actually pay them. So there's a whole kind of oversight thing that you have to have on that payroll for foreign employees and foreign contractors. And we have that's not really a specialty of mine. We do have tax advisors here at Robert Hall that work with that kind of scenario. That's once again not really specifically my lane of expertise, but we could definitely get you set up with somebody who can assist with all of that as well. Let's see, was there one other question over here in the chat box? Kirsten, can you only choose both bonus car depreciation mileage deduction? So once again, if you're writing off the bonus depreciation, you can't take mileage or actual auto costs. You can only take the depreciation. Once you take the depreciation, then you can switch back to the mileage write-off. Okay, so you can't take both in the same year though, unfortunately. So just make sure that you understand how that works. Lindsay, if you take cost seg and then sell the property to a different LLC that you also own, can you take it again? No. Great question, Lindsay. I like where your head's at, but you cannot double dip on the bonus depreciation. You have to carry your adjusted basis in the property into the LLC that you own. while you're alive, you cannot double dip. However, if you take bonus depreciation on your property, and let's say that your spouse and you own the property and your spouse passes away, I know this is a really dark conversation, but it is definitely something that has to be talked about. If your spouse passes away, the surviving spouse gets another stepped up basis on the property, clears out depreciation recapture, and then at that point you can do cost seg or start depreciating on the fair market value as of the date of death. So there is an adjustment upon death, but I know, once again, it's a dark conversation, but it's definitely something that you need to also consider, especially because, you know, people live and they pass away. So that's something you have to take into consideration. How do you take cost seg on commission income as a real estate agent? So you can't take cost seg on real estate commission. Cost seg only applies to rental properties, and it's on the large depreciable asset. You cannot take cost seg on the real estate commission side. Maybe I wasn't clear on this. The real estate commission income is one source of income. And if that realtor also owns real estate investment property, you could do the cost seg on the rental properties, and that loss helps offset all real estate related income. So you get the benefit, even though it's I've answered all the questions. All right. And I think people are hopping off as well. We managed to keep, 50 people still in the room. So no harm, no foul. It's a second set of eyes on returns that have already delivered. We're going to tell you straight up, hey, your preparer did a great job. We wouldn't have really changed anything. We could talk a little bit more about our services on the phone or in person. And maybe because our firm works year round and we do have a Rolodex of very, that it shows what, how old I am when I use the term Rolodex. We have a Rolodex of vendor referrals for cost segregation, for 1031 exchanges, for payroll servicing. Since we've been around for over 50 years, we have a pretty in-depth Rolodex of vendor referrals. So maybe just for that sole fact, you'd want to onboard with us. We are by no means a couple person operation. We have 55 employees here on staff. We're here year round, and we do focus on education and mid and year end planning. So we don't just file tax returns. We do that during tax season, and then during the off season, we plan with our clients. We sit down with them and we map out strategies in June, July, August, September. Then we have extension filing season. And then in the fourth quarter, we sit down with our clients again and we do a year-end planning. And that's all part of our education. That's all part of our planning division. And then during tax season, obviously, we file the tax returns. But we want to make sure there's never any surprises for our clients. We want to map out a strategy prior to the end of the year so that we already know what the tax return looks like even before the year is over, right? That puts you in a very powerful position to play and win the chess game against the Internal Revenue Service. So keep that in mind. Bonnie, how long will it take to review 2 years of tax returns? It's surprising, people think, well, it's going to take more than 30 minutes. Well, if you send us copies of the returns prior to the appointment, we'll have already reviewed the returns, come up with the ideas that we have as far as what to implement and strategies to discuss. So during that 30-minute appointment, I mean, it's 30 minutes of just basically Q&A and analysis. We already have reviewed the return prior to the promise and deliver. I don't want to underpromise, because then what's the point of that? And then you're thinking, well, what was the major change that all of a sudden, that was the part of the over delivering, So I like promising and I like delivering. That's the, sorry, I'm probably not cutting out. I actually am getting over a cold. So we will review your 2 years of tax returns prior to the appointment, so that the 30-minute consultation, we already know what we're going to advise and the strategies that we would implement. So we want to know about that prior to the appointment. All right, guys, I'm so sorry. I got to hop off. My noon appointment is here. So we look forward to speaking with all of you. Once again, best way to engage in our services, free consultation, is on the screen here. And then I'll talk with our marketing department to see if we can send out a link to review this. the next 5 to 6 months. So always continue educating yourself, and we will come back to you with all of the most up-to-date information possible. So thanks again, everyone. Have a wonderful day, and we will talk soon. Take care.